Okay, good morning and happy Tuesday. Welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today I want to share with you my charts to show you what my views are here for the markets. We've had a pretty volatile couple of weeks. Things have started to stabilize here over the past couple of trading sessions. So really what we want to talk about is where we expect markets to head next. Now, before I get started, what we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy any specific securities. So we'll start off as we normally do with a general market update. This is really where I want to paint the picture as far as the stabilization that we have seen. That has been my thesis for the past couple of weeks, that the volatility that we have seen is largely going to be contained, and we're not going to see this trigger a massive slide off or a sell off as some investors may have been looking for in the technology shares. But I do want to take a look at some of the sectors, because we are starting to see some sector rotation out of technology, despite the fact that technology remains the strongest sector still, despite the 10% decline. Then we'll take a look at fixed income and commodities, what type of signals that those markets are sending us to also paint us the picture as far as where markets are headed next, because I do think looking at those markets are very important. We want to take a look at volatility, where that currently stands and how that factors into our decision as far as what type of option strategies to utilize. I want to share with you some of our ideas that shapes our views as far as to help answer the question as to where markets are headed next. And if I have a few minutes at the end, I'll answer some questions from the audience. But let's go ahead and get started. The primary question that I want to answer is, with markets in a more stable state as they are here today, where are we headed next? So those are the answers that I want to try to help answer here on this morning's session. Now, my name is Tony Zhang. I'm the chief strategist here at Options Play. And what I wanted to share with you is my technical research, my charts that I utilize to gain my macro and outlooks on the market, my economic research that I'm currently looking at, and the different ideas that I'm currently scanning for in the markets. So let's first start off with the Qs, the NASDAQ 100 index. So last week we mentioned that the 270 level was the major line in the sand here. This was the breakout here from that 250, 270 level that the market spent a lot of time between June and the breakout here in early August. We had that big move to the upside and then a very quick crashing down, kind of taking the escalator up, taking the elevator down. And we've had a lot of volatility here over the past few weeks. Now, what we have seen is a stabilization, meaning markets are now stable above this 270 level. We're about to open up just shy of the 20-day moving average here, which has provided a bit of a very tight trading range. And the question is, are we headed up or lower next? Now, I'm curious to get a bit of a reading here from the audience here. How many of you feel that the markets are headed higher? Please type 1. And how many of you feel that the markets are headed lower? Please type 2 into the markets. Okay, so I see a lot of 1s, quite a few 2s. But it seems like a pretty balanced view between 1s and 2s. And I think that pretty much sums up where the market currently is, right? I think you have half of the market that basically will say, don't fight the Fed, we've stabilized, we're going to start heading higher. And then the other half of the market says, this is just a short-term pullback here. We're consolidating for another move lower. The answer is, it's hard to really answer that question as far as where we're headed. Only time will tell. But I do want to take a look at some of the indicators that may give us some clues. Now, when we look at the S&P 500, we have now managed to just barely reclaim that February 2020 high. So we're just above that at 340.99 in terms of the open here today, which is a little higher. We closed below that level. We're opening up higher than that. So S&P 500, again, also on fairly stable footing here, but again, not quite getting above that 20-day moving average just yet. Let's look at price action here today. I think price action here today will be fairly telling. If we see further strength, meaning the markets open higher and can continue to move higher past the open, then that shows us perhaps that we can continue moving higher. But if we open higher and then start trading lower again, which is what we've seen for a lot of the sessions here over the past few weeks, that's a little weaker footing in terms of the market. But there's a lot of cash sitting on the side. So as we have seen markets kind of decline, we've seen a lot of buyers step in here. We haven't seen the same type of options volume as we have, so I'm not expecting a huge move here to the upside. I do think that if you're going to get a move to the upside, it's going to be a very slow grind. And if we break below some of these major support levels, we could see another acceleration here to the downside. Now, when we look at small caps has provided quite a bit of protection here. So for, when the market sold off almost 10%, small caps only sold off about half as much. They also have bounced back fairly strongly over the past few days, but still small caps below that 160 level. That's a major level for it to stay under. Only if small caps can break back above 160 would I be in the camp that I think markets can continue to rally another significant amount here. When small caps lags behind like this and equal weight lag behinds like this, we're really not seeing a lot of strong upside here for the markets. Both small caps and equal weight providing a lot of defense on the way down, a lot of protection on the way down. They are gaining just a little bit in terms of relative strength, but in my opinion, not quite enough to justify a true rotation in the markets and showing that the health of this market rally is back. What we basically had is a little bit of relative gains on the sell-off and then a small amount of relative gains on the subsequent bounce, but not quite enough to reverse the slide or the underperformance of the small cap and equal weight indices. If we look at the individual sectors, this is where we do see a fair amount of rotation now. Now, this type of rotation, generally speaking, is healthy for the markets. When you have technology and communications start to rotate a little bit out of it, despite the fact that they still remain the two strongest sectors, consumer discretionary, technology, and communications are the three strongest sectors. But we are seeing materials continue to gather strength, and looks like we're about to open up just shy of this double top here and looking for a potential breakout here. So materials looking very strong, materials well above the February 2020 highs of 62, opening up here at 66, and can potentially move higher here. As you can see, both the daily and weekly money flow remaining fairly strong here. Momentum, at least on the weekly chart, confirming these moves higher. Daily chart momentum not as strong, so there is some weakness here on the daily chart, but on the daily chart, but the weekly chart still remains fairly strong. Same thing here for industrials. Industrials managed to get back above that June 5th high. Found quite a bit of support here over the past few weeks during the sell-off, and looks like it's potentially has the opportunity to revisit these 85 highs. And if we look at some of the commodities here in a few slides, that also supports this view that XLI, industrials, is one of the sectors to look at some strength here going forward, especially for any upside. We're more likely to see it in these particular sectors rather than, in my opinion, technology, as we're starting to see some cracks start to form. If we look at utilities continues to underperform from a relative basis. As you can see over the past few trading sessions, even though it has provided a lot of protection on the downside, it has made no progress here over the past few months here. So this is, from a relative perspective, underperforming, and this is really where we expect utilities, the fact that it hasn't managed to break above that 200-day moving average, will continue to trade sideways here, potentially start moving a little bit lower here to the downside, especially if markets can't rally and really start to move higher here. Utilities will continue to lag. Simply the yields that we're seeing in utilities, clearly not enough for investors to rotate into this particular sector. When we look at fixed income, this is really where there are some telltale signs here. High yield continues to be the strongest out of all of the fixed income markets. So when high yield is on the stronger side compared to treasuries, that has seen a bit of decline here over the past few weeks, this is really, signal of more of a risk on environment, meaning investors are willing to take on risk. When you start to see investors no longer willing to take on risk, high yield is one of the places that we start to see sell-offs very quickly, as we saw here during the coronavirus sell-off, one of the sharpest sell-offs in the fixed income markets. As you can see here over the past few weeks, no reactions at all while the treasury markets has seen a little bit of a decline. So meaning less favored for the riskless assets, more favor for the risky assets. This is more of a risk on indicator telling us that markets will likely continue or at least stabilize and may continue moving higher. But we really have a bit of a mixed bag here in terms of the different indicators that we're seeing. So the fact that we're seeing more of a mixed bag picture, this puts, I guess, more weight behind a potential pullback. But again, we haven't broken below those significant levels. We can continue to see markets actually continue to grind its way higher a little bit before we start to see some further downside. That's my view here on the markets. If we look at volatility index, this also tends to support this view here as we continue to get a decline here in volatility. This is the VXN, which is the volatility index for the NASDAQ 100 index. Very high correlation to the VIX, but given that the NASDAQ 100 is a primary index that many of us are tracking due to the huge explosion in technology shares in NASDAQ 100, mimicking more like many of our portfolios more than the S&P 500, we look at the VXN, as you can see, still trading at about 33%. So implied volatility of the NASDAQ 100 still pretty high here. So this still favors option selling strategies, whether you're selling covered calls, credit spreads. These are the types of strategies that you will find will have better yields in this type of market environment as volatility contracts, which means that we're more stable, but volatility still remains elevated, which means that we can collect more premium on these types of trades. Now, when we look at volatility in a different way, the VIX three-month versus the VIX one-month ratio, you know, despite during the sell-off coming back into more normal territory, it is quickly climbing back into that complacent area. Not quite there yet. We usually consider 1.25 as that complacent area. We haven't gotten back up there yet, but it is quickly approaching that level. So when we get back into that complacent area, that's really where we start to look for, you know, paring back our long positions. It's not, in my opinion, a great opportunity to short, but you know, we are now seeing some of these violent explosions in volatility happen when this complacency indicator gets above that 1.25 level. It's not there yet, but we are approaching it. So stable, potential upside, but there's also some of these things that are starting to bubble up from the surface that say, you know, things are not all completely okay, that we're just going to rally back up, that we don't want to fight the Fed and market's going to continue to rally. Another worrying trend that we see here in the markets is still the fact that as markets continue to climb, the number of stocks trading below its 20-day moving average has basically declined steadily for the last month. It's still currently trading at just 41% of all stocks are trading above its 20-day moving average. That's not what you generally want to see when markets are trading near all-time highs. Both the S&P, NASDAQ, and Dow Jones are within less than 10% of their all-time highs, yet the number of stocks that are trading above its 20-day moving average is in the 40% range. That means that you just have a few mega cap names that are dragging these markets higher while the vast majority of stocks are languishing behind. So this is, again, the worrying trend that we see, and it's not improving. If we saw that the markets were improving on this front, that would strengthen our thesis that markets are stable and we can continue to move higher. But this type of trend, along with complacency and some of the other charts we want to show you here, really lead to more of a worrying picture going forward. Now, if we look at copper, copper is one of the commodities that really has started to shine. So gold and silver dominating the headlines here over the past few weeks, but copper really starting to becoming much more relevant than gold and silver here over the past few weeks, as gold and silver really sit in that consolidation range. Dollar hasn't really broken higher or lower, so both gold and silver has just been stuck, but we've continued to see copper rally. We're continuing to see industrial demand numbers rally, and industrial demand is one of the things that have been driving our view of this rotation into industrials. So copper rising higher speaks to is more of a real-time indicator of industrial demand. And industrial demand numbers is really one of the economic numbers that has seen quite a bit of strength and economic surprise here over the past few months, really, and copper prices reflecting that. So this builds our thesis again for this sector rotation into that industrial and materials sector versus and away from technology and consumer discretionary. But when we look at the individual names, we still see some upside here. So specifically to the transport indices, if you look at the Dow Jones Transportation Index, it is outperforming the industrial index. This is one that we see some potential upside here. So CSX, many of the logistics companies, shipping, trucking, logistics, these are the types of companies that are seeing further gains here. And we have a major triple top here at 80. And CSX is potentially gathering the strength to break out above that $80 level here, which is the top here that we see. So right now we're watching for a potential breakout here. It hasn't broken out yet. So I would be cautious on pulling the trigger on this trade just yet. I would put this on my watch list, look for a potential breakout above 80. You know, this is the type of stock that generally speaking, I wouldn't expect it to just break out and continue moving higher. This would be the type of stock that I would expect would break out, come back to retest this as support, and then continue on moving higher. So for those of you waiting for a more higher probability setup, I would wait for that breakout, look for a pullback, and see if you can get a continuation higher here. That would be a much lower risk trade, in my opinion, to play for upside. And I think in this type of market environment, where we do feel that the upside here is fairly limited because momentum, number one, is lacking here. We do see some cracks forming in the market. If you're going to take long positions, be patient for them. Wait for the right setup where the risk to reward ratio is fairly attractive and that the stock doesn't have to move very far for you to cut your losses and move on and take a small loss on that trade rather than pulling the trigger right now and potentially having to wait much larger of a stop loss before you cut your losses. So wait for that breakout, wait for that pullback, and then look for that opportunity to go long. We have seen travel stocks also pick up. We're seeing this across the board. If you look at Expedia, if you look at Delta Airlines, if you look at the hotels, Hilton, really one of the ones from a chart perspective, looks fairly attractive here. You have this $90 level that it has, you know, provided fair amount of support and resistance that has now managed to break back above. So if you look at $90 as like a bit of a support or resistance, this is the setup that I was waiting for on CSX, where you had the breakout above the level, came back to test this as support, and yesterday's push here was the confirmation that that support level is holding. So this is really a bit of a rotation into some of the travel stocks as well, which started to pick up some steam here early on, but really was a bit too early and immediately gave back those gains, but now really slowly starting to build up some of that momentum. It hasn't quite gathered enough momentum yet, but I think this is one that's on my radar. It's the travel stocks that are gaining some momentum. Certainly hotel stocks are likely going to recover a little faster than airline stocks. Expedia, if you look at the type of online travel agencies that focus predominantly on the leisure space, that's also one that we think is going to be fairly strong here compared to, you know, any type of corporate travel type arrangements. So Hilton, Expedia, those are some of the names that we're paying attention to here in the travel space. On the flip side, if we look at the technology names, this is really where we do see some charts that are a little bit more concerning. So if we look at some of the big FANG names like Facebook, now Facebook falls into a slightly different, I would say, category than Apple from the perspective of most of their revenue comes from advertisement. This is really where we are starting to see a bit of a top form here in some of these names. So after that bounce, we certainly have seen a stabilization, but the price action since that stabilization continues to look fairly weak here. If we look at money flow here on the daily chart, looks fairly weak. Momentum is quite weak here as well. Our concern is that some of these stocks are going to start to break down here to the downside. They haven't broken yet, but price action here doesn't look particularly strong. When the Qs are up, almost 1.5% pre-market, and Apple is up almost 2% pre-market. Facebook is basically flat. This tells us that this type of strength is not gathering in names like Facebook. We're also seeing the same price action here in Alphabet. Alphabet looking even weaker than Facebook. As you can see, we had that recent decline, rally, subsequent decline, and it really hasn't bounced off of those lows the same way the Qs and Apple has. So this is really one area of the FANG names that we see some potential downside here. This also leads us to believe that the upside here for technology names is somewhat limited when you have mega cap names like Facebook and Google, where their relative strength is starting to fall behind. So they may not be falling behind, the price action may be relatively okay, but when they're losing ground on a relative basis, this is concerning when the big names in this particular category are starting to fall behind. We see it also in some of the stocks that really took advantage of the lockdowns and the coronavirus in terms of people staying at home, like electronic arts. We've seen this decline here, and it's now back to June highs here. None of the big technology names are back near its June pricing. So now that we're back in that June pricing, really has broken below some major support levels that the other names have held. So this leads us to believe that some of these lockdown names are really starting to come off. We're seeing this in eBay. We're seeing this in a lot of other names. So the segment of the market that really drove a lot of the strength on the recovery, starting to see some losses here on the downside. So we see this on both eBay, Etsy, electronic arts, a lot of the gaming stocks. So a lot of names in the technology space starting to look weak. A lot of the lockdown names starting to look weak, and we're starting to see a rotation here. Some of the travel stocks gathering some strength. Some of the lockdown stocks starting to lose some strength here. So we're starting to see a bit of rotation here. So that covers what I wanted to share with you here today as far as what my views are. But overall, things are stable, but limited upside, and we're starting to see cracks here form in the market. So be careful as far as how you place your trades. My preference here again is to look at selling volatility, especially cover calls. With the elevated volatility, if you have some stock positions, selling cover calls right now is a great way to generate some yield, so that if you do get some kind of acceleration to the downside, you can use some of that yield to purchase some puts to the downside. So I have a few minutes here for some questions here. Raju is asking, I think Facebook will fill gap down. What's your opinion? So again, my view on Facebook is that it's still holding, but the fact that it's losing relative strength day by day is concerning to me. You could see this go on for another few more weeks, though, before it actually gaps down. So my preference is to sell cover calls, sell call credit spreads here. So basically betting that it's not going to rally significantly here. I don't know that I'm ready to pull the trigger on shorts just yet and buying puts. How do you see Disney? I haven't looked at the Disney chart here in a couple of days. Let's take a look at Disney together. So Disney, the communication sector still remains fairly strong. We're seeing that rotation into Disney, but Disney, after breaking out above this 127, 128 level here, has really not managed to make much ground here. So could this roll over? Possibly, but I would wait for a breakdown below this 128 level before I would see, Disney rolling over here. But, Disney Plus numbers last time came out fairly strong. Perhaps along with the travel stocks, you might see Disney continue to gather a little bit of strength. So I'm not as bearish here on Disney. BBY. Best Buy, I can't help but think that these are the types of names like eBay and Electronic Arts that gathered a lot of gains from the coronavirus lockdown that are going to start to see a little bit of weakness here. Best Buy holding up fairly well here during the sell-off. Some of the staples and discretionary names also coming to life. So Best Buy, from my perspective, is a little bit more neutral. What do you think about oil stocks? I think oil stocks will continue to decline. If you look at ConocoPhillips, if you look at Exxon, a little bit of strength here yesterday, but I think that's the type of strength that you want to sell into. I think you're going to see further declines here for energy stocks and XLE. Hold Apple through the day and close tomorrow morning. Apple's event here today, is going to likely drive, it's hard to say. I believe in the future of Apple very much, especially with their new, ARM chips, where they're going to have the same chips across all of their devices, and it really brings all three devices in line with each other. Because I'm a big fan of Apple, but the phone and iPad is very different from the MacBook. Once the ARM chips are in, I think that is the future of kind of having a unified platform across all of your devices. That's what's lacking. I see some upside here for Apple. I still like it for the long term. That's my personal view here. Short term, I certainly think that you are seeing a bit of a temporary top here for Apple. What about inflation? Inflation expectations really haven't taken off here. So if you look at tips, inflation expectations haven't gained much over here over the past couple of weeks. It really has been fairly flat. So I don't necessarily think inflation is going to take off as we kind of saw. And you see 10-year yield actually coming down and stabilizing. This also shows me that inflation expectations is now particularly strong. Travel stocks, which do you think are best in class? I wouldn't know which one's best in class, but I would certainly focus on the names that are the names that are focused more on leisure travel rather than corporate travel. We have seen no uptick in corporate travel demand. Leisure travel starting to see some of that uptick. So with that, thank you so much. I hope that you guys find this useful and helping you start your day. Tesla opening up substantially higher here. I think this is more a little bit more hype on Battery Day and some of the other things that they have in place. It's really difficult to bet against Tesla here for those of you that like it, but there are some concerns from my perspective that Tesla is getting a little overcooked again here. Some of the complacency that we're seeing are in names like Tesla. So be careful getting into some of these names like that. Okay, thank you so much. I hope you guys have a great trading day, and I'll see you guys next week.